Hello again there, folks, and welcome back to another discussion in your accounting and financial management course. In this video, we are going to explore the different forms of business organizations, as well as the standards accountants are to follow when preparing financial statements. We will then conclude by looking at the three different types of business activities. Are you ready? All right, let's get started. There are three different forms of organization for businesses. They include sole proprietorship, partnerships, and the corporation. Let's take a look at each now. The sole proprietorship is characterized by single person ownership, simplicity in setup and decision making, a limited life, meaning when the owner stops working, so ends the business, unlimited liabilities to the owner. They can lose personal assets in the settlement of the business debts, and business profits are taxed in the hands of the individual owner. Partnerships are similar to proprietorships, except owned by more than one person. There's usually a formalized written agreement, and with more people, there's an ability to raise more capital and share ownership responsibilities. Each partner has an unlimited liability, and income tax is paid by the individual owners. A corporation is a separate legal entity recognized by the government and taxed on its own income. Individual shareholders pay separate tax on their dividends or capital gain tax when their shares are sold. It has an ongoing lifespan, meaning it is not dependent on the life of one shareholder. There are usually higher startup costs, but there's also usually easier access to capital. Shareholders also enjoy limited liability. GAAP stands for Generally Accepted Accounting Principles, and these are the rules and practices that accountants must follow. In Canada, there are two sets of rules that govern the preparation of financial statements. Publicly traded corporations, those companies whose shares can be bought and sold on the stock exchange, must follow IFRS, or International Financial Reporting Standards. Privately held companies may use IFRS, or they can choose to follow a less rigorous set of rules called Accounting Standards for Private Enterprise, or ASPE for short. Our final topic for discussion is the three types of business activities. All companies are involved in all three activities, and they include financing, investing, and operating. Financing activities involve obtaining funds to finance the operations of the business. This might be done by securing a loan with a bank or a lender, or this could be achieved by selling shares of ownership in the business. Investing activities involves the purchase or sale of long-term assets needed to operate the company. This could include the buying or selling of any property, plant, or equipment not held for trading. Operating activities are the other day-to-day activities of the business. This includes the selling of the goods and services of the business, as well as realizing the expenses incurred to support those sales.